Hello guys, welcome to my YouTube channel. This is my first video and I'm going to do a breakdown of ICT concepts and how I implement his strategy, his concepts into my own trading. Okay, now let's just do a quick breakdown of NQ. This is the main instrument that I trade, and I start with the daily time frame and I do a top-down analysis. Okay, so we're going to look at the swing low of the higher move of NQ. We take the swing low and we take the swing high, and we see how price comes down to the 50% level, right? Which is called the discount level. This is where you want to see price have a reaction. It's coming down to the fair value gap as well. Comes to the 50% and then goes higher. When you see these two bear candles, I'm sure beginner traders are thinking that the price is made its higher, made the top and is going lower, but that's never the case. The only time you want to look for shorts is when price is breaking the swing low and going lower. Until it does that, you cannot be bearish. I mean, you can definitely take shorts in if you're scalping and you're on a very low time frame, sure. But on the overall daily bias, you want to stay bullish at all times, okay? So as you can see, price goes to the 50% level, and I'm gonna do a breakdown of today's trade, which is Friday, February 2nd. I'm not gonna nitpick pick some random day. I'm gonna do as of today, okay? So today's price action was pretty nice. I want to go down to the 1 hour time frame. Let me just turn the indicator on. So this indicator shows all the days of the week, and we're looking at Friday. Okay, before we look at Friday, we want to see what happened Thursday. Thursday was, especially at 4 p.m., was a big day because it was earnings for Apple, Meta, and I believe it was Amazon. And as you can see, price went up 200 points at 4 p.m. Right? And after it closed around here, and then you see the Asian range, you see price just ranging the whole time, and then dropping at 8 a.m. during the NFP. But if I go at a lower time frame, I'll break it down even more for you guys. You can see, let me just get rid of this fib. You can see how it reacts over here, right? Let me just get rid of it. So this is a previous day high. Let me just mark it out for you guys. This is something I do every day, guys, at the end of the day and before the morning session. I always make sure sorry, I did the wrong one. Make sure I put the indicators or drawings on the charts just so I can see what's happening. And as you can see, the price makes that high yesterday, at Thursday, at what is that, 4:50 p.m. Eastern time, and around 7:20 it gets close to taking it out, but it drops. Now, retail traders will think that that's resistance and prices has now displaced lower and it's going to keep going lower. But that's not the case, guys. If you're trading ICT, you know how liquidity works, right? So this is not just a previous day high. This is also relative equal highs, which makes it, what do you call this? You would call this buy side liquidity, right? Let me just also put that mark up there for you guys. Buy side liquidity. You want to see price go higher. As long as your bias is bullish, you want to see price actually go lower before it goes higher. So if this is a midnight line and you're picturing the daily candle from the opening price at midnight, you want to see price wick down below and then go higher. As you can see, that's what happened today. Now, when it does this at NFP, for example, at 8:30, a lot of traders think this is a 100 point. What is this? What would you call this? A 100 point move, yeah, 100 point drop, and people think, okay, it's done, it's going lower for the rest of the day, but that's not the case. Because when you incorporate bias and inefficiencies and premium discount, as well as standard deviations, as you see these lines over here, day trading ICT concepts can be a wonderful thing. And I'm going to show you this example right now. As you look at the Asian range, you can see the high and low of the Asian range, and each line represents one standard deviation away from the range. So this would be the -1 standard deviation, -2, 3, and 4, and this will be the +1, 2, 3, 4. Okay, so as you can see, price drops all the way down to the -4 standard deviation, and at 9:30 a.m. it does this. Okay, does this and rejects it. Now, this is all great, but what is the entry? Like, when do you want to enter the market? Now, there's many ways to enter the market, okay? Now, I'm going to show you some drawings. So you see the fourth standard deviation. You also see the 5-minute fair value gap inefficiency, okay? So you see this. It comes down to it, closes it, and then turns around. Now, there's three things that are happening here at this point. 9:30 open, it's going to the fourth standard deviation. It's also closing the 5-minute fair value gap, and it's also taking out, what is it taking out? It's taking out these relative equal lows, okay? And it's rejecting it. Now, if you go down even further to the 1-minute time frame, guys, I will show you the possible trade setup you could have taken, or maybe some of you guys already did take that trade. Now, when price drops with these 3 straight bear candles, takes out that liquidity, and then you see that fair value gap, a lot of new traders will think, okay, fair value gap, enter a sell short here and hope it goes lower. But when you know the narrative in mind is bullish, you want to see price break through this fair value gap and continue higher, which is exactly what it did here. Exactly in 933 candle, it goes up 30 points up, breaks through that candle, and guess what it creates? It creates an inverse fair value gap. If you watch ICT videos, you have some experience in it, then you know what an inverse fair value gap is. When it closes completely higher and then it comes down below just there, right over there, you can take your long, guys. Take your long and put your stop loss right before the swing low, and you can take your trade. You can, if you want to be mechanical and profit taking, you can take profit exactly at 2 to 1, right? Or you can take profit at the previous swing high. Or if you really want to hold it for as long as you can hold it for your previous day high buy side liquidity that I showed you guys over here. And you can leave a runner for the rest of the day as well. Now, when it comes to profit taking, it's really subjective. Some people are very mechanical with taking it. Some people take it at certain areas. Honestly, the best thing I would suggest is taking partial profits. Take it at certain areas where you think price may turn around. So, which is this high over here, the previous day high, and you can also move your stop loss further up as price goes higher in your profit. So this is one of the trades guides from the inverse fair value gap, and it goes higher. Okay. Now let's stick to this 1 minute, and I'm going to show you the next setup. Now, say you are not trading at the 9:30 open, because sometimes price can be very volatile, and you're obviously still a beginner, and you don't want to get whipsawed out, and price just takes you out quickly. Also, bear in mind there was 10 a.m. news. So when 10 a.m. news is coming out, people tend to wait 30 minutes before taking a trade. So when that happens, you can definitely wait. And when 10 a.m. hits over here, you can see price just ranges, goes up, down for a while, does not really do any move, right? So when that happens, you know one thing, you know that the previous day high is not taken out yet. So when the previous day high is not taken out, the liquidity is still above this area. So when you're looking for liquidity, you want to see sell stops being weighted. So what are sell stops? This swing low, this swing low. You see this? Price comes down, makes traders think that it's going lower. But in reality, guys, it's just taking the sell stops. So you can see this. Oh, oops, wrong one. You can see this sell stop rate takes it out. Once again, 2 straight bear candles takes it out, and followed by what? A big bull candle in the 1 minute. And once again, what does it do? It breaks the fair value gap and forms an inverse fair value gap. So if I draw this out for you guys, you can see there it is. You see price breaking through it and then coming back into the inverse fair value gap and then going higher. This is once again another setup you guys can take. Take it here with the stop loss below the swing low. One sell side is taken. You don't take this trade if you don't see any liquidity being taken first, the opposing liquidity at least. And then you can take price at this swing high if you want to be, or you take partials off here, but you want to keep it usually at the previous day high. This is a 2 to 1 trade, guys. You can take partials off here and hold for the rest of the day. If it comes out to break even, it's okay. That happens. That's how trading works. You just, at least you took partials at previous day high and you made money. That's what matters. Okay, now let's say if you're not a 1 minute time frame trader and you're on a 5 minute. Okay, so when you're on the 5 minutes, you can see how price reacts on that time. You notice that price makes a high over here at the NFP and makes a lower low. When it makes that lower low, it takes out all that liquidity, and then you see the price going higher again. So what does this mean? This makes it a bullish breaker. So when you take these 2 candles, I like to take the body, not the wicks, because the wicks can sometimes be, very wide, and I don't want to have a wide stop loss. So you guys see the breaker, you can take it here. Let me just get this thing here. There you go. That's the breaker. And look how price reacts to it, guys. It does it first time at 9:50. If you're waiting for 10 a.m. news, you don't take the trade, okay? You wait until 10 a.m. hits. So when this happens and you're not trading, you can get emotional and you can see price going away. But don't worry, guys. Price, if you just stay patient, it will work out more times than not, okay? So when price comes down at 10 or 10:30, you can take the trade here realistically with a stop loss below this body of the breaker, which is about 40 points of stop loss, and you hold it. Either you want to hold it for, again, look at that, a 2.1 risk to reward ratio, taking out the previous day high, taking partials off here, and then letting the rest run. That's one way to look at it. Now, I personally would not take the trade because of the fib retracement. I like to take trades when it comes to the discount level. So as you can see, price does not come to the 50% level, guys. It comes right above it and then goes higher. So also there's a fair value gap here that I would have liked to see it touch, but this ended up being a breakaway gap and it went higher. So it's okay. If you miss a trade, you miss a trade. You move on. It's never over. And I'll show you exactly why in the next setup, how missing trade doesn't mean that you're done and you can't trade more for the day at least. As long as you're bullish, your bias doesn't change. So once the previous day high gets taken out, that does not automatically mean the price is done making its higher high and it's going to drop for the rest of the day. It's a bullish scenario. You know that price can continue going higher. You want to follow the trend, okay? So you take, once again, you see the price with this swing low and then takes a higher high and takes the previous day high and then retraces. Now, I usually would take the fib retracement from the displacement level where it displays higher, not the rejection, because unless it was a small rejection, I may have taken it. But it's, again, for me, I just based on my 6.5 year experience, I like to just take the fibs based on what I'm seeing. And in here, I'm seeing a big wick, so I'm not going to take the fib there. I'm going to take it based on the actual displacement level, the two big candles. Take it there with this swing high, and it comes down. Guess what? Comes down right to the 62% level, which is another setup you can take. And it's not just a 62% level; it's obviously a fair value gap here and here, and you got this order block over here. You see this candle, the bear candle before it's bullish. That's what you call an order block. So you take the trade. You can have a stop loss 31 points right below the order block, and you once again you can hold it for to take out this high, which is a 1.85 risk to reward, or you can wait for the 2 to 1, or it depends on your profit taking, guys. You can follow the standard deviations, which I'll get to just now, and then you can take profit there too. Now, as I was talking about standard deviations, you can see how price reacts to the standard deviations of the Asian range. As you can see here, it went down fourth standard deviation before it started making a move higher. And as soon as it got to the 1, 2, 3, 4th standard deviation, look what it did, guys. I'm sure you guys can obviously see it. It goes to the 4th standard deviation and has a big sell-off. This is what I mean when I say price is an algorithm. It's not random. This things happens over and over again. And the fact that it can happen over and over again, that means we can exploit it for profits. Okay, so you can see price rejecting this and dropping below with a sharp drop. Now, retail traders, beginner traders will think that this sharp drop means that price is going to continue going lower now. It's done for the day. That's not what it means. You want to still stay bullish no matter what. And as you can see, this example here, people might think it's a fair value gap and it's going to go to the fair value gap and turn around and go lower. That's not what it means. As long as your bias is still bullish, it can continue going higher. So you want to see, instead, mark down the fib retracement from this swing to this, and you see how price comes down to the 62% level, does not close below, leaves the wicks 3 times, and then eventually goes higher, comes back down, and then it makes a higher high. So this is another trade, guys, you can take from the 62% level, okay? Take it here. Now, obviously, a lot of people take trades on the 50% as well. I like to, just based on my data that I've collected over years, I've noticed price comes to the 62% way more than the 50%. So just to have a better risk to reward, I like to take the trade here. And if I miss it, then it's okay. And as you can see, my stop loss will be below the fair value gap over here, just in case. And I will put it at the consequent encroachment of this wick of the candle. And once again, you can hold it for 2 to 1, or you hold it for the new high being taken out, which is 2.1 to R, 2.1 R. You can take it out, and I soon take out partials and hold for runners. But seeing that it's 3 p.m. and price has already moved about 300 points, you can take your final profit here and just be content for the day. Okay. Now that was one setup, and then you can see as price takes out this high. Now, what is the significance of this high as well? Let me show you guys. If you go to the daily and you see this is what last Wednesday. This is the previous, or this is Wednesday. It's a previous week high. Last Wednesday's high. So if I just mark it up for you guys quickly, previous week high. You see that? Look how price goes exactly to that level and turns around and drops at 4 p.m. for the rest of the hour before the market closed. This is what you call an algorithm, guys. These are certain targets that price reaches for, and no matter, as long as your bias is a specific bias, you guys can see these patterns happen on a daily basis and make good profit with that. Okay, so if you're a beginner, I hope this video helped you guys and showed you how certain setups can happen and where to take the trades and where to take profit. I also did not mention that price also did not take out this swing low. So if you take out this fib retracement here as well, you can see how price over from this dealing range from yesterday from 4 p.m. to here, that big move that happened at the earnings report. You can take the fib as well and look how it comes to the discount level all around here. 62%. It's all, look at the confluences. There's 60% retracement. You got the 5-minute fair value gap closure. You got the forced standard deviation. You got the sell stops rated and then moved up. But guys, if you see these moves happen, take that trade. Like, these are the highest probability trades you can find in on the charts. So you just have to be patient. You just can't, expect it to happen very quick. Just be patient, and these setups do form all the time. Now, guys, I hope you enjoyed this video. It is my first video. If the audio is bad, I do apologize in advance. I'm using my AirPods, and I really hope that you gain some knowledge from this video. And please comment if you have any questions, and don't forget to like and subscribe. Thank you.